Good afternoon, everyone. I'm here to discuss quantitative investing, and I'm hoping to bring a fresh perspective by the end of this from the many other quant presentations that you would have seen so far. Over the next 20 minutes, I would be talking about the technology that drives quant, some of the traditional ways quantitative investing has been practiced, and some newer approaches to quantitative investing. Markets have become faster, deeper, and far more complex than the way investment decisions are still made. It's like we are playing catch up all the time. In such environments, investing success is rarely about having the right opinion. It's about having a process that continues to function when opinions fail. Today I want to talk about quantitative investing, not as a product or a prediction tool, but as a way of operating in modern markets. One disclaimer, I'm a purist when it comes to quantitative data-backed led investing. But I also believe that human-led, conviction-based investing and quantitative investing are complementary styles in a holistic equity portfolio. I want to run you through the adoption gap in quantitative investing between the US and India. The total equity AUM in the United States is about $40 trillion, out of which 35%, which amounts to approximately $14 trillion, is managed quantitatively. When we look at the same number in India the equity assets are roughly $1 trillion, and less than 1.5% is being managed quantitatively, which amounts to just $15 billion. This gap is not a judgment, it's a timeline, which states that every market that matures eventually moves to process from discretion. The parallel I want to draw here is from medical sciences, and I'll stitch that up from a point from my previous slide, which was complementary styles. Surgery was once done entirely manually. Today, complex procedures like LASIK, knee replacements, and even brain surgeries for that matter, are performed by robotic precision. The human still decides whether to perform the surgery or not, but the act of performing the surgery is better done by machines with far greater consistency, without any fatigue and without any emotions. Progress in medicine did not come from replacing humans with machines, but from combining human judgment with robotic precision. Investing is no different. There are areas in quantitative investing where a robot performs better than humans when it comes to scale, consistency, and bias reduction. Human judgment still defines objectives, constraints, and intent. Coming back to the US-India gap, this data is not about penetration, it is about belief and trust. And trust in investing comes with time. Let's talk about the ingredients that go inside building a quant engine. We typically divide a quant engine into two phases. Phase one being the signal synthesis phase. And let me highlight another point. At its core, a quant engine is an end-to-end decision-making process. So coming back to the phase one, which is the signal synthesis phase, the engine records the data, then it structures that data and converts it into signals. The next step is that it filters all the noise from those signals, and then it combines and interprets those signals. Phase 2 is the portfolio construction phase, where signals translate into patterns, which by the way are infinite, but constructed on finite data sets using linear and parallel computation. This encapsulates pattern recognition, which is basically the process of identifying structures in markets that repeat over time. The engine then constructs portfolios and overlays the portfolios with the risk mechanism. And then, once the portfolios are constructed, it is executed with discipline. A quant engine does not treat different markets differently. For example, 100 years of US market data can be used to identify patterns that also apply to 25 years of Indian market data. The engine learns from these patterns, not geography. It has the capability to evaluate patterns on a 1-day time frame, 1 week time frame, 1 year time frame, and even 100 years for that pattern. Each pattern is analyzed independently to understand its unique signals. At the same time, all the signals are processed in parallel and see how they interact. This allows the quant engine to capture both short-term movements and long-term structural trends simultaneously. From this slide, I want to highlight that data is basically the fuel for a quant engine. More the data, more the number of patterns. And with more patterns, the engine learns better. And with better learning comes greater efficiency in a quant model. Quant investing has always been synergistic to single factor and multi-factor approaches. I want to take this opportunity to attempt to demystify and talk about a newer perspective which is beyond factors. What if the limitation is not any individual factor, but the idea of factors itself? Traditional quantitative investing has largely been organized around labels like value, quality, low vol, momentum, etc. These factors are basically man-made templates that have worked historically but are not first principles. Markets do not experience value or momentum in isolation. What they experience is market behavior, configurations, probabilities, and dependency of variables. And once a framework becomes widely adopted and widely used by everyone, it starts to lose its edge. And we all know any strategy adopted by everyone ceases to be a strategy. Once you start thinking beyond factors and first principles, that is where atomic investing comes in. This nomenclature was born out of our think tank sessions, where we were looking at markets from a microscopic lens and trying to build various hypotheses and concepts around that. We defined atomic investing as an approach where markets are decomposed into their smallest repeatable units of patterns. Traditional multi-factor approaches say momentum works, value works, quality works, and then combine that and hope that diversification works. Atomic investing asks different questions. Which patterns are working right now? Which interactions are breaking down? Which combinations are strengthening? We at Dolat have developed 6 atomic signals with 3 states each, namely bullish, bearish, and neutral. And let me tell you, just with 6 atomic signals and 3 states each, the engine is evaluating and calculating 729 configurations every minute. The goal is never to find the perfect factor. It's about to build an engine that adapts to changing market conditions. When you combine this level of computing power with deep historical data, you are no longer constrained to a single market time frame. The system can analyze short-term patterns, medium-term patterns, and long-term patterns sequentially and in parallel. This allows the quant engine to assign probabilities to different market outcomes and identify opportunities as they emerge. As we all know, markets are not linear, but they are driven by recurring patterns. And pattern recognition is the ability to identify these recurring patterns. The quant engine deploys 2 forms of computing, which is sequential and parallel. The sequential logic defines how decisions are made and also defines the priority of those decisions. It basically governs the entire decision flow in the engine. Whereas parallel computing defines how simulations and calculations run across the entire stock universe and individual stocks simultaneously. Let me put forth 2 examples to drive my point. There are 30 to 40 trillion cells in a human body and around 2 trillion galaxies in the universe. Has anyone ever counted these numbers? Obviously no, because it's humanly impossible to do that. But scientists have used patterns and math to arrive at these numbers by decomposing these huge entities into their microscopic structures. Pattern recognition does the same to decode markets. At this point, many people instinctively feel that successful investing is about being right most of the time. One of the most important lessons from quantitative finance is that this simply isn't true. The most successful fund in human history, and one of my favorite funds, which is the Medallion Fund, operated with a hit ratio of just 51%. In other words, it was wrong as often as it was right. And with this hit ratio of 51%, they were able to generate a CAGR of 66% over 20 years. And with a max drawdown of just 25%. What mattered was not accuracy. What mattered was probability, position sizing, and discipline. Let me begin with Dolat Quantum Leap and Enigma, which is our proprietary in-house quantitative signal engine that we built in-house. Enigma was built on a 10,000 core CPU architecture, which allows us to run millions of commutations in a matter of a few minutes. This also allows us to test and refine newer strategies day in, day out. It is continuously maintained and updated like an Android or an iOS to keep generating newer strategies. Dolat Quantum Leap, which is our long-only PMS, was constructed using Enigma. It reflects the engine's systematic and structured approach towards investing. And let me tell you, all the data that goes into Enigma is survivorship bias free. Enigma also has an adaptive framework which makes it robust, agile, and intelligent as more and more data is fed into it. After talking about Quant engine, beyond factors, pattern recognition, atomic investing, and Enigma, I'm proud to highlight the backtested returns of Dolat Quantum Leap. And let me tell you, these are all non-curve fitted backtesting numbers which are highly accurate. On the performance front, we have presented 1 year, 2 year, 3 year, 5 year, and since inception numbers. The reason to do that is 1 year reflects adaptability. The 3 and 5 year reflects robustness in the strategy. And the since inception numbers reflect the long-term compounding discipline built into the strategy. And at Dolat, we always focus on consistency and not episodic outperformances. This is a data-heavy slide with the numbers representing your 3-year and 5-year rolling returns of Dolat Quantum Leap, which is carved out of the Nifty 500 universe, and benchmarking it with the Nifty 500 and also highlighting the alphas that it has managed to generate over these years. On the screen, you can see the numbers from the year 2001 till date with the rolling 3 years and 5 years period. The key takeaway from this is that Dolat Quantum Leap outperformed the benchmark in 22 out of the 23 rolling 3-year periods. And in the 5-year rolling periods, it managed to outperform the Nifty 500 every time with a significant alpha. What this tells us is very simple. The strategy just doesn't work in one field every phase. It has demonstrated consistency and robustness across multiple cycles. This slide captures a classic picture of how winners and losers behave within the portfolio. The data covers the last 5 years, where we plotted the largest winners and the largest losers on the background of the chart, alongside the table highlighting the top 10 winners and the top 10 losers. What stands out clearly is the asymmetry. The average winners are almost 6 times the size of the average losers. That's not accidental. It reflects the design of the strategy. Winners are allowed to compound and losers are cut early. In fact, this disparity in the average winners and losers is what generated the alpha. Over this 5-year period, we managed to clock a CAGR of about 32.5% with a hit ratio of roughly 56% and a max drawdown of around 23%. Stitching a point from the medallion slide, you don't need to be right all the time, you just need your winners to meaningfully outweigh your losers. With this, I would like to conclude my presentation and happy to take any questions. Thank you.